Friends, family, and fellow alumni of the University of Chicago. My name is Madeleine Johnson, and I graduated from the college in 2007. On behalf of the Alumni Club of South Florida, I'd like to welcome all of you. We're glad you took the time to satisfy your intellectual curiosity this afternoon by attending the Harper Lecture. This afternoon's event is just one of the many events and lifelong learning offerings available through our Alumni Association. There are also our Uncommon Core sessions during Alumni Weekend, alumni-led programs, and our alumni travel, and countless other opportunities to reconnect with the university. Let me also take a quick moment to extend a special thank you to Howard Cohen, I think I saw, Jane Lee, and others of the Alumni Schools Committee for joining us today. These gatherings of fellowship and the camaraderie would not be possible without the commitment made by all of us to the advancement of the university. I'd also like to recognize Ron Falcone, who's joined us, the Vice President of Communications from the Booth Club, who will close the event a bit later. Our club supports nearly 4,000 alumni, parents, and friends across this region. In the last year, well over 100 of you attended events in South Florida and participated 80 times on 13 different volunteer committees throughout the university. This is an incredible outpouring of support and just goes to show how much pride we share in the university and all of the great work that comes out of it. And now it is my distinct pleasure to introduce Ali Hortaçsu, the Ralph and Mary Otis Isham Professor of Economics and the College at the University of Chicago. Professor Hortaçsu is one of the first economists to systematically study online marketplaces to improve their efficiency. He has published widely and is currently co-editor of the Journal of Political Economy. A fellow of the Econometric Society and research associate at the National Bureau of Economic Research, Professor Hortaçsu has engaged in research with Google, Microsoft, and the US Department of the Treasury. Please join me in welcoming him.
It's my pleasure to be here. Thank you for all coming. And I was, thinking of what to talk about today. And I went to school at Stanford, and for undergrad, if I were doing an alumni talk for Stanford alumni, I'd probably put up some pictures, wave my hands. But this is the University of Chicago. I know this is this is a serious crowd. So let's. I didn't put any calculus in there, but there might be some equations in there. So let me just say, this is Chicago style. If you have any questions, please, let's do this interactively. Please go ahead and ask. If I'm not making sense, if you think I'm saying something wrong, please put up your hand. We'll have a discussion. So let's go. So okay. So I worked on auctions, I guess, for the last 15 to 16 years. And you might say, sort of, why do we do this? Let me just go back to sort of Econ 101 to say why I wanted to study this field of economics. So Econ 101, I would say in the first week or the first 2 weeks, you're going to be introduced to supply and demand. Right? So demand curve is, well, we have lots of people who want to buy, let's say, bottles of water. So some of them are thirsty, they want to pay a lot. Some of them are not thirsty, they're not willing to pay that much. So we rank all these people from starting with the person who has the highest willingness to pay for the bottle of water, going down to those people who are really not that thirsty and don't like water anyway, they like the Coke, so they're willing to pay very little. So that's how we draw the demand curve in Econ 101. On the supply side, you say, well, okay, there are people who are producing, let's say, bottles, or maybe these water wells, or these retailers with different inventories, if you will. Some of them have a lot of bottles to sell. Some are it's more scarce. So we have sort of people with different costs of producing or selling these water bottles, and we come up with a supply curve. And in Econ 101, we say, okay, supply equals demand. There's this happy place here where, right, there's a price at which demand is going to exactly equal the supply. Right? The quantity demanded, this Q star, is going to be the same as the quantity supplied by these people. Okay? So we take that as given in a sense. The invisible hand is going to take us to this happy place. And we talk about why that's the happiest place to be. This is the sort of the magic of the markets. Because the argument goes, that's a happy place, because if we had set the prices too high, right, then all these people would be willing to supply this good, right? But there wouldn't be enough demanders. People would say, right? So people at this point, only a few people would want to buy that good, right? On the other hand, if you set the price too low, then a lot of people would want to buy it. Not enough people would be willing to sell it. So again, there will be this imbalance between who's willing to sell and who's willing to buy, right? So the right place to be is this place where this is exactly equal. And and the other argument is that, so if we try to increase price a little bit or lower, we're always going to have this imbalance, and some people will be potentially worse off if we try to force this price on this market, going to these other price places. All right. So this is the usual supply-demand story that we talk about. But where I came to this when I was just taking my first econ classes is, this is great, but you never told us how you find this thing. Right? You draw these curves in the textbook. Where do you find this price? Who's going to set this price? So in a sense, for the last 15 years, if you will, my research has been try to understand in different settings and in very different markets around the world, sort of how do we set a price? And how do you come up with a price that clears the market? So the caveat is, the set of markets that I'm going to analyze are, in a sense, in the minority of markets, right? The majority of goods transactions, these are, these are the marketplaces that we're used to. And a lot of the times, when you go to the supermarket, right, we don't run an auction, right? The supplier sets a price and wait for consumers to arrive and buy at that price. Okay? That said, you'll be surprised, right? That maybe in this, but the place where I grew up, in Istanbul, in Turkey, there is no price, or there is a price, but nobody expects to pay that price. You go there, and you haggle, and then, you go between the guys and say, look, your peaches, this guy is selling with that, give me a little bit something. And the guy says, no, I can't give you that. I say, come on, I'm going to buy a little bit more pears too. And, that way you're going to come down to a price where, it depends on your negotiation power. Right? But so one question is, even in the prices are set from beforehand setting, how do firms know what price to set? Right? So I'm sure many of you have been involved in this, or even sort of you're selling a house. How do you set that price? Right? Your real estate agent comes to you and says, let's list it at this. How do you know that's a good price? Well, if the real estate agent is any good, he will say, well, these are the comps, right? These are the houses that were sold, in the last 5 months in this area with similar amenities. This is what is sold, so we think we should go here. But still, how do you know that's the right price? So this is where auctions come in. Auctions are probably, it's an ancient mechanism. The first use of it was documented back in the Roman Empire, although they probably go even before that. In the Roman story, they were selling the Roman Empire through an auction. There were a bunch of people who were bidding for it. The members of the Praetorian Guard, I believe. One of them won, was named the Emperor. He was killed 10 days later. So it wasn't, the winner's curse happened to him after this. But auctions are a place where it's a mechanism through which we can find the right price to sell, if you will. And traditionally, we think of this as selling of really special goods, right? So I give here the example of a painting. But it turns out in a lot of countries, I believe in Australia and in some other sort of Commonwealth countries too, real estate is done through auctions. It's not through this set up price and then your listing agent does it. Actually, if you go out west, maybe even here too, when you list a house and 25 people come with cash offers because they have, they work for Google or Facebook, in effect, you're running an auction as well, right? So what do we do if we have a painting to sell? This is a family heirloom or something, or somebody gave you this painting that's nice, but you don't really have space for it in your house. You want to sell it. You can list it these days. In old days, I guess you could go to a consignment salesperson or to Sotheby's or Christie's, one of these auction houses. They would have run auctions through a calendar. People would show up at their auction house and bid on this thing, and the consignment house would take 10%, 15% fee. You don't have to go to Sotheby's or Christie's anymore. You can try to sell it on eBay, or they told me talk about Latin America, Mercado Libre. So this is one example from eBay from Friday night when I was writing these slides. So this is some painting, I guess Victor Menard of painting of Canadian soldiers being auctioned on eBay. And eBay gives you a wealth of information on what's going on, right? So as a seller, you can put up the picture, all sorts of details about it. And the seller has, this clearly is some sort of like an auction house or some intermediary, because she or he has 6,935 feedback offers. So it means this is not probably a private seller. And there's this feedback thing. Most people were satisfied with this transaction. And this person is running an auction. And it says, okay, the current bid is 521 English pounds. So 819 US dollars. If you click on the bid history page on the eBay web page, you'll see sort of the history of all the bid prices that were entered by these people following this auction online. Okay? And this auction hasn't ended yet. It still has 5 days and 15 hours and 2 minutes left. Okay? And by eBay standards, this must be a super popular auction. So because most listings on eBay these days hardly ever get a bid. So a lot of times people have to relist these things. But this one is particularly popular. So they had 4 unique bidders duking it out between themselves, giving 71 bids. Okay? So and then you see this price sequence here, but let me explain to you how the eBay system works. So actually, let me get a show of hands here. How many people have actually bid on eBay? That's okay, so I shouldn't even talk about this. Okay, so for those few who haven't done this, right? So in eBay, you can either place a bid, you say, I want to bid this, or you can place something called an automatic bid. Okay, what's an automatic bid or a proxy bid? Is, suppose this is basically you give eBay your maximum bid, the maximum amount you're willing to pay. Right? That's what eBay asks you. So suppose Harry says, okay, I'm willing to bid up to $500. And at the same time, Larry puts in a bid of $550. What eBay software will do is immediately show Larry as the current high bidder, because 550 is bigger than 500. Okay? And it will show the current high bid as $510. Why is that? Why not 550? Because eBay's rule is we're going to show the second highest bid plus the bid increment at that price of $10. So it's going to go up to $510. Is everybody with me? Right? Okay. So once again, this thing about, even though I put in 550, eBay is not going to show that as a price, right? It's going to show the second highest bid plus a small amount, some increment. That will be the running high price. Okay? So Harry now sees this price at 510, and goes and talks to his significant other. Says, okay, we were thinking maximum $500, but how about 520? Or maybe 525. So 520, puts the 520 bid in. The eBay computer, once again, shows Larry as the high bidder. But now, this has gone up to 530, because 520 plus $10 bid increment. This is still below 550. And at this point, Harry says, okay, I give up, because 530 is greater than the 525 maximum that we put on this. Anything beyond that is going to break our budget. So the auction expires, and Larry is the winner at $530. So at this point, we can say we may have reached one of those happy places, right? Because Larry is happy because he was willing to pay $550, but ended up winning this at $530. So I have at least, Larry has $20 surplus left. Okay. Harry, at this point, he lost the auction, but if this, if this is a University of Chicago alumni, we'll have no regrets because he'll say, well, we decided 525, the price was 530. It's too bad, but let's not dwell on it. That's, let's not make this a sunk cost. Let's move on to the next painting. So in that sense, this person has no regrets and does not envy Larry for it. Right? Some people call this an envy-free situation. Harry says, well, okay, good for Larry. He paid 530 for it. I was willing to pay at most 525. So in this sense, again, and the seller is of course very happy because the seller, this point, when he or she put this painting into place, had no idea how much this painting was worth. And these two people came in and bid this thing up to $530. Okay. One more point about the seller though. So I would say sort of, if you take one thing out of this about auctions, one thing I should point out as the most important thing here, right? If only Harry or Larry had showed up to this, if you didn't have a second bidder, and the seller had not set a minimum or a reserve price to this, if the seller has said, I'm willing to sell this thing at anything above $0, if let's say only Harry had showed up, what would the price have been? $10, right? Or $1 actually, because I think $1 is more correct, because at the $10 range, the bid increment is $1. At 500 is $10. So this shows you sort of, you need at least two bidders. And I think sort of that's sort of in general a good insight. Right? Even if you're looking for a job, for a house, with one, you have to negotiate really hard. You have to really figure out what that person's willingness to pay is, and set a price that's slightly below that so that you get a good price for that person. But if you have two bidders, a lot of times that's just enough. Those two bidders will compete against each other and set the price to a really good level. So generating competition, generating entry to the interest to your auction is probably the most important thing you can do in a setting where you're trying to set a price. All right, so we can talk about sort of, a lot of people who've analyzed these things mathematically, and sort of that's where the economics of auctions is. So, and people talk about optimal bidding strategies in these situations. So what I'm going to claim is that in the eBay setting, in the example that I gave, if everybody knows exactly what the value of the painting or the good is to themselves, then bidding an automatic bid or bidding up to your maximum willingness to pay is the best strategy you can follow. It's a simple strategy, and it's not even a strategy, it's a very straightforward thing to do, but you can't do much better than that. Right? I think, I'm thinking sort of it's probably intuitively obvious, but basically what happens is if you sort of suppose you say, okay, I have my own strategy, even though I'm willing to pay $550 for this thing, I'm not going to pay a penny above $450. Suppose you try to commit to that strategy from the outset. Right? You will very soon find that that commitment is not something you can follow through with. Because as soon as the price goes above $450, you will say, but hey, the price is $460. I'm still willing, I'm willing to pay $550. I'm still making $90 out of this thing. So maybe I'll just match that price. Right? So in that sense, that type of a commitment to a strategy where you bid below your value is not going to be something that's enforceable down the line. Right? You're going to be, basically you're willing to pay up to $549 in that situation. Okay? So this is what, again, it's a very intuitive thing to say, being willing to bid up to your value should be an optimal strategy. So, you can put places an automatic bid, or if you're really sort of an eBay junkie, or you have a fast internet connection and you're willing to stay up at night, putting the bids in, you can increment your bid until you hit your maximum valuation. that's an equivalent strategy that can go on. I just want to say, when I claim this, bid your true value, this part of the claim is the most important one. If you know what your value is, that's a big assumption. Or assuming that other people also know what their values are. Okay. So I didn't make a slide here for this, but one phenomenon that you see in a lot of these online auctions is something called sniping. How many people know what sniping is? Okay, so there's a few up there. So I showed you the bid history page here that you see the time path of these bids, and there's about 5 days and 15 hours left until the auction ends, and there are about 71 bids. Most auctions on eBay, you don't have any action until the last hour. In fact, I would imagine that there's going to be, if there are 71 bids up there, there'll be 100 or 200 bids probably in the last half an hour to 30 minutes of this auction, with a lot of the bids coming in maybe at the last 5 minutes to 1 minute. Okay. What's going on is that a lot of times, let's say we have some potentially valuable antique for sale, and there are some antique dealers out there who are looking for these things. They might think, look, if I begin to start bidding for this thing right now, all these people will see that somebody is willing to bid for this thing. And they'll begin to dig around to see whether, is this something potentially valuable. Right? By bidding and showing that you're interested in, you invite competition to enter into the auction. Okay? So a lot of the more sophisticated bidders decide to wait until the very last second, and maybe even they have a computer program made exactly so that that bid comes in 5 seconds or 1 second before the auction deadline expires, because you don't want to bring people, you don't want to attract people's attention by creating more bidding activity here. So basically, that's a type of pattern, and again, why does that occur? It's because my bidding on something, again, tells people that there is something valuable out there. Or, if they thought that something was worth, maybe $5, and suddenly they see a value of $100, bid of $100 out there, they might really double think, take a double take, and update how much they're willing to pay for this thing. And what will happen is that the person who bids early is going to suffer from revealing his or her information too early. So if you look at, again, eBay auctions, you see this type of behavior really becoming obvious sort of at the very dying seconds of the auction. There's going to be this huge flurry of activity going on. Okay? Let me just say a snippet here. I'm going to compete away from my hands a little bit, but a lot of the debate about high frequency trading is about this as well these days. I actually was giving a talk at Citadel, the hedge fund in Chicago, and I met a guy who used to be an electrical engineering professor at a very good state school. He was hired by Ken Griffin to build a computer that has specialized chips that can bid and the computer was going to be installed at a facility right next to the exchange's computers to cut down on the transmission time. And they couldn't write software to give the bid in, because software would take too long. They would have to build specialized hardware to give the bid in. So in some of these financial markets, the sniping type phenomenon happens at such fine time scales that there are now physicists writing papers about the relativistic corrections to the transmission of these signals, and how should we take that into account. So in some ways, you can read Michael Lewis's Flash Boys, or so there's some popular accounts of this, but you see this type of phenomenon going on in many, at a really crazy scales these days. So let me say another thing about the auction. So we said something about this revealing of the information. So again, sort of one good thing about the auction is this price discovery or value discovery process that in the eBay auction, right, before we ran the auction, we didn't know where people stood. After we run the auction, we know a lot of information. We know that there's one person out there that's the losing bidder, who in my example was Harry with $500. It has, 500. We see in the situation that Harry is dropping out of the auction at $530. We learn that Harry has value that's less than $530, and we understand that Larry has valuation that's above $530, right? So that's a lot of information that we get from the auction. And a lot of companies, actually eBay, Google, sort of, who run auctions, utilize this information, right? Now you get all this information about people who have bid on different auctions. That information might be very useful in figuring out what types of things that these people might be willing to buy. And more of these intermediary type companies are actually leveraging some of this information, what people are doing in these auctions, and given that they're willing to bid this thing, maybe they're willing to buy something similar to that. So there's a lot of value in this information. All right. So let me just say a little bit, do some name dropping right now. So some big names in auction literature. There was an economist named William Vickrey at Columbia, not Chicago, unfortunately. But he wrote the first papers on auctions in 1961, and then he got the Nobel Prize in 1994 because he invented what's now called the second price auction mechanism. And the second price auction mechanism is essentially what eBay is using. It's the idea that if you run an auction and you charge the winning bidder the bid of the second highest bidder, then you're going to get people bidding up to their true values. Right? Again, what's the key insight here? You're not going to charge people the price that they bid. You charge them the price set by somebody else. You charge them the highest competing price. Okay? And how can you do this? Again, this sort of eBay, sort of this escalating type mechanism is going to achieve that. But what Vickrey showed is that if you just people to bid sealed bid as well. If you ask people, okay, give me your bid. I'm in a sealed envelope. I'm going to choose the highest bid, and that's going to be the winner. But the winner has to pay not the price, the bid that he put into the envelope, but the bid, the second highest bid among all others. Then Vickrey would argue that everybody should be bidding their true values. Okay? And why is that sort of intuitively possible? Again, as the winning bidder, right, I want to bid as high as possible without exceeding my budget, because I don't worry about being exploited. So I'm going to still make a profit because I win if the second highest bid is below mine. And that's the price that I pay. I don't pay the price that I put in the envelope. So that pushes me to bid as high as possible that's within my budget range. Once again, it's a very simple idea, super simple idea. If you search for Vickrey's 1961 paper, there's very little sort of mathematics or anything in there. It's just this idea that's being said. But this idea is used in eBay to sell billions of dollars of stuff. Another even bigger marketplace is Google's, where does Google make money? Their AdWords platform. And I just met Anton and Seth here, who actually know this much better than I do. But let me just talk about Google's AdWords auction, one of the biggest auctions that are being run today and really shaping the way we actually approach this online world, right? So this is how Google makes money. So suppose you put in something like Colorado Springs hot tubs. Okay. But what Google will give to you is going to be what's called sort of sponsored links and organic links. So sponsored links are things at this top where these people have paid to be placed on this Google search page. And also on the side, these are also paid links that people have paid to be featured here. Okay? And these at the bottom, I guess on this page, they're not paid, although they look like they could be paid as well. So what happens in the situation is that suppose this is a simplified view of the world, but suppose I'm a hot tub operator in this area. I go to Google's AdWords platform and I search for the keywords hot tubs in the Colorado Springs area. And Google asks me to enter a bid for that keyword. Okay? As applied to the Colorado Springs area. Okay? The bid you enter is in terms of what people call in this industry a pay-per-click, a PPC. What is that? If I go to this web page and I click on this thing, right, immediately Google would charge to the credit card listed for that hot tub operator's account some dollars, maybe $1, maybe 50 cents, something of that order. Okay? So you might say these might be tiny things, but some of these keywords can be extremely valuable. For example, at some point in time, the keyword mesothelioma had a pay-per-click of $23 per click. Everybody knows what mesothelioma is, right? This is the asbestos stuff. And I guess you can guess who's bidding for that keyword. I said this, and the students in my class immediately started clicking on those links. Luckily, of course, Google sort of does some corrections to this. So Google is supposed to sort of disregard excessive clicking from the same IP address. They detect this as click fraud, etc. That's what they claim they do, so that people don't respond. But I think at our sales team here, might know better what really goes on there. So okay, so you enter this pay-per-click, indicating how many dollars you will pay for a click on this keyword, right? And this makes a lot of sense from the advertiser's point of view, because why are you willing to pay something? Because if somebody puts in Colorado Springs hot tubs, that's a really good customer lead, right? This person really wants to buy, is looking for that service. It's much better than sending out mailed out ads or putting ads on the newspaper, and you have no idea who's going to see those ads. This is the customer seeking you out, and you want to be there at the moment the customer is looking for you. And that's Google's business model. Put the providers in front of the customer at the moment that they're searching for you, and of course they're going to charge you something for that service. And that something is determined through these auctions. And literally, that's why Google has this giant computing platform, right? Because they're running billions and billions of searches every moment of our days. Every time somebody puts in a word, they're going to go to their database of bids for that keyword and show the ad of the person who's bid the most for that keyword. And they have to do that computation in real time. Between the time that you put in that search word and that page is pulled up, they have to also find the ad content that goes with that and put it in front of your face. Okay. There are some subtleties of this. For example, Google doesn't exactly rank the ads by the pay-per-click. They also do something called, they weight these pay-per-clicks by something called an ad quality score. Okay. This is because that there might be some businesses out there that are not maybe the best providers, or they're really newbies in this industry. They're willing to pay a lot per click, right? But people, once they get that top spot, there's something funny about that ad, and they will just not click on it as much as, let's say, somebody else who has a much better ad out there, but they just didn't pay enough for it. And so sometimes some ads have higher quality than others, and Google wants to maximize its revenues for it. So they have to figure out what this ad quality score is. And I'll tell you a little bit about how they came to this. How they actually have they run a lot of experiments between these ads. So something like 1 to 5% of the ads that they run for these keywords are reserved for experimentation. They randomize the ordering of some of these ads to see at these random positions how many clicks will come to them, regardless of this pay-per-click rating. Okay? And this highest pay-per-click weighted by the ad quality score gets that top spot. And if you look at the data on the pay-per-clicks, there's a really huge difference between how much you pay for this versus this, for example. Right? This top spot may be twice as much as this. And this is by 2007 knowledge. Maybe 2014 things are different, but again. And okay, Google made 15 billion revenues in 2014 quarter one. Most of it coming from AdWords. And this is still a very huge business these days. Okay. Any questions? So I don't want to I'm going a little bit.
Can you go back to the
Please.
slide you said in the last two, the second highest bidder gets the third spot and the third highest bidder?
Yes. So okay, Google gets the pay-per-clicks, puts this ad quality score to them, and then what happens is the highest bidder for that highest bidder for that keyword will be placed in that top center spot. Sorry, here. Okay, but that bidder is not going to pay the price that they said they're going to pay. They pay the price, the second highest pay-per-click bid by another person. The second highest pay-per-click is going to be placed here, but they pay the price that's bid for by this person.
So going back to the previous theory you were talking about.
Exactly. So the idea is, if you're charging people the second highest price rather than your price or the price right below you, you might have incentive to reveal how much you're really willing to pay for this thing, and you cannot do better than doing that. That was the idea that they implemented to do this. And thank you for asking that, because that really segs me to the next aspect of this. So we have this. We have this Vickrey story about, well, if you charge people the second highest price, then they might have incentive to reveal their valuations truthfully. But does that help the seller? Is that the best way to run the auction? It's good that people don't have to strategize too much. I just have to declare what my true value is and not have to strategize too much around it. But maybe there's a different way to sell the things where people do strategize a bit, but it actually extracts more revenue from the buyers. And obviously, companies like Google or eBay, etc., so they might be willing to invest into learning what goes on. And I'll tell you later, there are a lot of big sellers out there that are very interested in making even a small dent in their businesses by optimizing the auction. For example, you might say, why charge the highest bidder the second highest price? Why don't you charge that person the price that they bid? Right? If that person said, I'm willing to pay $23 for that mesothelioma keyword, why don't you charge that person $23 instead of charging that person the $10 that the second highest bidder said? Aren't you losing out on $13 there? Okay. So that auction where you would charge the winner the price that he or she bid is called the first price auction, not the second price auction, because you're charging the winner the price that they said they're willing to pay. Okay. So is that a better idea? Is that going to make more money? Well, turns out it's not so easy, because if you tell people, look, you're going to bid 50, and if you win, I'm going to charge you 50, people are not going to reveal what they're willing to pay, because even if I win, I'm not making any money from this. Right? I'm going to give as my bid something lower than my true willingness to pay is. So this is called bid shading. Okay? And in the first price auction, which is what a lot of people do when they're running auctions, especially in the sealed bid, procurement type context, you charge the winner the price that they said they will pay. You no longer have the incentive to bid your true value. You're going to submit a bid that's slightly below what your true value is. So even if we charge the highest bidder the price that she bid, the price you end up getting is going to be somewhat lower than your valuation. Right? You're not extracting the full value that the bidder is willing to pay for it. You're going to extract something a bit less than that. Before, we were not capturing the value of the highest bidder still. Right? We were capturing the value of the second highest bidder. Now we're getting the highest bidder surplus, but only a percentage of it, not the whole amount. So the comparison is between, well, is the second highest bidder charging the value of the second highest bidder better than charging whatever this percent of the highest bidder's value is. So this is where the math comes in. And again, sort of, if you don't follow this too much, that is totally fine, because I don't think, this is a big challenge with this kind of auction. The analysis of this type of auction suddenly becomes super, complicated. This is where, and I won't show you the differential equation, but the solution to this type of auction situation is a solution of a linear first order differential equation. Now I go out and talk to people who bid on procurement auctions. When I talk about linear first order differential equations, they look at me as if I'm crazy. And I think there is some point to that. Theory has to take into account, what people are actually doing. But let me tell you what I think people might be doing. So suppose my value from winning is V. What I want to do is to choose a bid such that in the event that I win, which happens with some probability, I want to maximize my profit. So this is my profit when I win times the probability of winning. So if I win, I get V minus B. This is my maximum willingness to pay minus the bid that I'm paying. And there's some probability that I'm winning. Okay? So all the sort of calculation should be finding that sweet spot in terms of this B as to what B is going to maximize this product of these two terms. Okay? Because if I set B too high, well, my probability of winning the auction goes up, but what I get at the end of winning goes down. So there's a trade-off between these two terms, and I have to find the balance between winning the auction versus profiting when I win the auction. Yep. And as I said, then it becomes a really important quantitative exercise to figure out what this probability of winning if you bid the amount B is. It becomes a really important quantitative exercise to figure out what that is. And if you were a game theorist, sitting at one of the economics departments, and there are a few of them in at the University of Chicago as well, they would say, oh, that's easy, that's a differential equation, you solve. But in most real world settings, what I think is that people from experience, they have a good sense of what this probability of winning this kind of auction is with a bid is. So if your life is spent bidding on, let's say, highway paving contracts, right? Or some other contract, sort of, you bid on 20 of these things a year, or I'll show you some other auctions where people are bidding on these auctions every hour of the day. You begin to get a pretty good sense of what you need to bid to actually win this auction, or with what probability you're going to win this thing. Well, let me tell you one example as to what theory would predict, and let's see whether you would actually believe in what the theory will say. Okay, so suppose we're bidding for let's say, a first edition Freakonomics signed by Steve Levitt. There are two bidders, and we know that the value for this thing is between $0 and $100. Maximum $100, minimum $0. And we know each other, that both of us have this valuation that's between $0 and $100. And let's say it's uniformly between, so there's no bell curve or anything. It's any value between 0 and 100 is equally likely to happen. And suppose you are the person that you really like Freakonomics, you love this stuff, and you want to get Steve Levitt's signature on that page. So you're willing to pay up to $90. How much would you bid if you knew that your competitor also had a value between 0 to 100? Anybody venture a guess? Go ahead. $1. Very good. Why?
Because it's random, so it's pretty much can win, but
So, but okay. So, are you likely to win with a bid of $1?
If it's a Monte Carlo and you're randomly sampling numbers between 0 and 100,
So,
all numbers are equally likely.
correct. All numbers are equally likely. But so this is a first price auction in the sense the highest bidder wins, and you pay what you bid if you win, right? So I would say $1 is a bit too little because, I mean, maybe not, depending on the situation, right? But because you have only 1% chance of winning this auction potentially, right? Let's maybe get another guess. 80. Very good. So why did you think?
Because I still want it less than my value, but
Yep. Yep. Close to your value. Very good. And that's what about 2,000 or 3,000 experimental subjects who bid on these auctions have bid. You're very close to that. I'll tell you what theory says you should bid. You should bid 45 according to theory. I'll try to tell you without writing the differential equation why this is true. And again, I might miserably fail here, but here's why. So the idea is, I didn't write all the steps here, but you're basically thinking both of us are going to bid some fraction of our value. Okay. Let's say that fraction is k, right? Some numbers below 1. So, and if I bid a value of b, and if my competitor is also bidding some fraction of their value is between 0 and 100, right? So my competitor's value is going to be somewhere, up from 0 up to k times 100, right? If we're bidding half of our value, right, it will be 0 up to 50. If you're bidding 75% of our value, this k will be 0.75, so it will be up to 75. So my probability of winning is going to be, so if I bid b, and this is a uniform distribution, everything is equally likely, the likelihood that I win is this b divided by k times 100. So my profit is proportional to my value minus my bid times this b divided by k times 100. But this is a constant here, so I don't have to worry about it. I said proportional to. So my expected profit is 90 minus b times b. This is where you do one line of calculus. You look for what is the b that maximizes this product. You take the first derivative of this thing, which is going to give you 90 equals 2 times b, and gives b equals 45. Again, I'm sorry if I lost you there, but this is one thing I want to illustrate here is there's, a lot of assumptions and a lot of calculation that goes into here. And this is what, if you had two game theorists going at this, they will be bidding 45 in this. And again, in general, if you had two game theorists playing this thing, and if their values were v, they would be bidding half their V's in this auction.
Can I ask you a question?
Please.
This all makes a lot of sense when you know the number of bidders. But
Yes.
when you were talking about Google AdWords, for
Yeah.
example, you have no idea how many
Yes.
people generally are bidding on the Google AdWords.
Yes.
So how would you actually work your way through to coming up with the appropriate bid?
That is excellent. So first answer is Google AdWords auction. That's the second price auction. So there you don't care how many bidders show up. It's in your best interest to bid your value, no matter what anybody else does, because you're not setting the price. Somebody else is setting the price, and you just want to make sure, sort of, you know, I'm winning in the situations I want to win. Here, it is crucially important how many people are entering. So there, you will have to guess how many people might enter, how will this affect this probability from winning is. You'd have to do all this calculation yourself. So in that sense, it is a very complicated calculation that you have to make. Moreover, it's not just you. You have to figure out what other people are doing, what calculations they are doing, because you're in a sense strategizing against what they are doing in this situation. So as I pointed out, so 80, bidding 80 when you have a value of 90 is very close to what people actually do when they're asked to do in these lab experiments. So there are a lot of people out there, you know, paying undergrads in different institutions to play these games. And, you know, out of, let's say, 100, 200 economics papers that have been written on this, maybe too many papers, but almost all of them have found that nobody bids 45. People bid something above that. So here I would say, don't listen to your economics professor. Because people out there are not going to follow this, and that's not, bidding 45 is going to be too little. You're not going to win the auction if you bid 45. Bid something a bit higher than that. Indeed, what I would say is that, you know, what you should do in this type of situation, and this is what people are doing, is look at the history of auctions. Again, look at similar auctions. What bid has won? And what bid do you think would be needed to win the auction 25%, 50%, or 75% of the time? And against these probabilities, gauge, okay, well, if I bid this, I make a lot of money, but I only win it 25% of the time. If I bid something higher, I make less money, but I win with 50% of the time. And if I, you know, bid even more than this, I win a lot of the time, but I make less money. So just compare these, make a little spreadsheet for yourselves, and then, you know, optimize, find the bid that maximizes your expected profits from winning. Okay. How am I doing on time? I have 5 minutes. Okay. I have a lot of slides about I hope I'm not, you know, thank you very much, by the way, for the questions. I really feel sort of, let me just say sort of, I have to tip my hat to one of the, you know, really great economists who actually is at Chicago right now. Probably one of the premier auction theorists alive today is Roger Myerson, who got the Nobel Prize in 2007 for his work on optimal auction design. And what Roger showed in his work, which is extremely technical, but let me try to put it in one slide here. A lot of people had analyzed these games like first price auctions and showing, you know, deriving these complicated strategies, etc. But what Roger proved a theorem, which is called the revenue equivalence theorem, that showed a pretty surprising result. He basically said that the gains from really optimizing an auction are potentially really small. And what's the intuition again? The big intuition is, in the second price auction, people are bidding their values, but they're paying something a bit less than what they said they're going to pay. They're paying the second highest bid. In this auction, you hold people to their bids, right? You ask them to pay what they said they're going to pay. But in response, people are going to shade their bids a bit. So you lose some revenue that way. So what Roger showed is that in a large class of situations, if the people who are playing these games are game theorists, then the average revenue from a second price auction and the first price auction will be the same. He mathematically proved this. It is, not an easy theorem to prove. It's not completely hard either. There's some intuition to it. But he proved this theorem, so it's called the Meyerson revenue equivalence theorem. And hence, since then, a lot of people have said, look, this is a second order question. That first price, second price, it doesn't matter too much. Meyerson showed that in many situations, if game theorists are playing this game, it doesn't matter. Okay? The counter to that is, of course, people are not game theorists. They might be, doing all sorts of other stuff. So you might have some gains from optimization against this more behavioral, that economists like to call agents, that people do whatever they do for psychological reasons. Yeah. Another thing that Roger showed, this is where some optimization can happen, is how to set a reserve price. When the seller sets a minimum bid, that can become also very important. And let me just say from the AdWords perspective, the Google AdWords perspective, there are a lot of AdWords out there for which there is no bidder at all, or maybe at most one bidder. Right? That would be, you might say, 99% of the keywords that actually Google sells or that are queried. Because these are some really weird stuff, whatever people are searching for, nobody's really willing to go there. So what should Google do if there is potentially only one bidder showing up at the auction? Well, you should set, what this theory would say, a minimum price. But how do you figure out what that minimum price is? Well, you have to look at the history of auctions, to the empirical distribution of bids, and say what minimum price is going to maximize my revenue through this experimentation. So I did a little bit of just to sort of, this is shameless, self-plugging here. So in 2007, I spent a few months at Google. Halvari invited me to sit there for a while, and there they had this question of sort of, on the web page that I showed you, this was back in 2007, they had the rule of not showing more than 8 advertising slots. So the question was, why 8? The answer was, Sergey likes 8. Okay? Sergey Brin, the co-founder. He thought more than 8 just looks ugly. Okay? So we said, okay, well, all right, so what if there were 9 or 7? Doesn't it depend on the keyword? How many slots you put up there? So what we did is basically we did some calculation. We had this auctions with different sort of. So what they would do basically, if there's 5 bidders out there, they would put 5 slots. But if there were 9 bidders out there, they would put only 8 slots, but still take the bids. So we did some calculations of, well, what if we optimized based on the pattern of bids that we're getting for that keyword, the number of maximum ad slots that you would be able to that you should put on a page. And the result was Google could potentially raise revenues by 6% by this optimization. And 6% of X billion dollars was I wasn't paid. I was a visiting researcher. They just paid for my plane ticket and the motel I stayed in for 3 weeks. That's what I got from this. So I'm not a good bidder myself. I'm a game theorist. Okay. So what I want to say, the message here is sort of, I just want to say sort of, I talked a lot about theory here, but right now the field of auctions has become much more, let's say, data-driven. In the sense, what Meyerson had to do is, I don't have much data on bids. I want to say something based on a priori just logical reasoning, what should happen in auctions. That's what Vickrey did. But a lot of these margins as to how do you set the minimum reserve price or number of slots out there, or how do I auction something out, it is beginning to turn out that these are very empirical questions that you can answer, A, by experimentation, or by looking at the data that you have and sort of doing some calculations with it. By modeling this, through, some of these bid strategies that we derive, and against this, optimizing these parameters. And a lot of times you can actually find significant differences that these auction intermediaries can benefit from. And in this case, it was up to about 6% of their revenue at that time. Let me just actually, since I have not too much time, but let me just say one more thing here. So one more, I guess, substantial thing here. Until now, I talked about auctions, again, where you know what your value is. There's a very important class of auctions where you don't know what the value is. And the canonical example is when you're bidding for an oil well. Right? So there's the Gulf of Mexico, or oil tracts in Texas, or you could also be bidding for now fracking, fields, etc. There's an oil deposit down there in the ocean floor, and the amount of oil is the same for all of us who are going to bid for it. So this V barrels of oil in the well is common to all of us, but nobody knows exactly what this V is. Right? This is the situation. So what do the oil companies do? They send their geologists out there on a ship, and they send seismic signals out there, and they do a seismic survey. And based on what their software says, they say, okay, we estimate the volume of this rock formation that could hold oil to be this much. And in this type of porosity or something, there will be this much oil. So the geologist says, there's X barrels of oil in the well. And let's assume your geologist is competent, that your geologist is, on average, is going to be okay. But as you know, that there's going to be some margin of error, right? Maybe there was too much waves in the ocean that made the measurement not so good. Or maybe the analyst made some error unwittingly as to what the value of the oil well is. And I actually do this. I was going to do this, unfortunately, but I do this in class. Just think about, try to visualize this baby. I have a jar of coins. I put it on the table, and I asked my class to first look at the jar of coins, and I asked them to bid for it. Let's run a second price auction for it, right? Give me your bid, and we're going to pick the highest bid as the winner, and charge them the second highest price. Or you can do a first price auction as well. Doesn't matter. Okay. So what happens in those auctions, in the coin auctions, is that I always make money. And then I buy donuts with that at the end of the class. So maybe I should buy something, quinoa salad or kale salad or something. But why is that? That's called the winner's curse. So the question is, if your geologist is telling you that there's X barrels of oil in the well, should you bid X? Turns out the answer is, don't do that. Don't bid X. Geologist says this, bid something less than that. Why is that? Suppose there are 100 other bidders out there with their geologist telling them what the value of the oil in the well is. Right? When do I win this auction? I win if my geologist was the most optimistic geologist. Right? Even though he's well-meaning, on average he's right, but it could be that whatever that measurement error is, at that time he got unlucky, or there was this big error that showed that I have the highest estimate of this thing. So you have to take into account that winning the auction in this situation, winning an auction in this situation is bad news, potentially bad news, because you were the most optimistic about something that was uncertain. Everybody else was going for it, right? And we know this. I know a little bit from the real estate context. You're like, look at that great house. So the price is only this. Let's go in Russia and buy it. You're like, but hey, this has been around for 120 days or 260 days. Why not? There must be something going on, right? So what you have to think about is, are you potentially going to regret winning this thing once you win, because you're just winning because you had the highest estimate of this thing? If you ever fear that, if you ever are in a situation like that, don't bid what your geologist is telling what the value is. Bid something less. So now if you ask me, how much should I bid? Right? I would have to do something probably about 5 times more complicated than what I had to do for the first price auction. That's where the game theorists are. It is hard, sort of, if any of you want to read these papers, I'm very happy to send you some of these papers and discuss them for you. But this is where, again, this theory is that, the message that I can distill in English is just don't bid what your geologist says. All right. The other story that I want to tell about this, and is not on the slides, and I'll end there maybe. In these situations, make sure you're not bidding against an expert, because you're going to lose. One of my favorite papers in the auction literature is by these two guys, Ken Hendricks and Rob Porter. They analyzed some of these oil well auctions. And they found a set of auctions where one of the bidders was a company had an oil well in the tract next door, and the other company was somebody who didn't have any experience with that area. And what they found is that whenever the company that wasn't experienced won the auction, they lost money down the line. They almost never made money in these things. But whenever the experienced company won the auction, that company made money. So these are situations where what we call adverse selection is very powerful, and you have to be very sure that you're not going against people who know what they're doing much better than you are. So this is actually another example of this. I don't know if you see this show, the storage auctions, where they have there's a storage locker people are supposed to look in, and almost every episode there's somebody who falls prey to this winner's curse because they bid way too much. They think they see something, and then so where is this stuff going? So auctions are not just for oil wells. So Google AdWords. So I'm sorry. Today, sort of in many parts of the U.S., the way the price of electricity is set every hour of the day is through an auction. Okay, it's a more complicated auction where you're actually selling, not just a single unit of electricity, but many units of electricity. And it turns out, though, the bidders are very sophisticated. And this is, again, a bit of a shameless plug. This is one of my favorite papers that I wrote. This is so this is a picture where there's a demand for electricity. There's the blue line. There's the cost curve for these generators. And the bid of this person was this green line. And we had the theory that predicts the red line. And there we said, okay, victory. So we have, these people at Reliant Energy in Houston, are bidding exactly according to theory. And this is one of the markets where this sort of more complicated optimizing theory actually really works very well. And you can see, and I'm not going to explain why they're bidding below cost here. That's because sort of there's, they have these forward contracts and they're sort of short sellers in this part of this part. But you can see that these guys are actually making a lot of profit in this situation. They're bidding above their cost here, and they're making substantial profits. Anyway, so other work we're doing, we're working on auctioning of government bonds. US government finances its debt by selling government bonds to investors. They sold $7.9 trillion of bonds last year. So we have a project going, trying to sort of figure out how these bidders are bidding for these things and see if we can make, a fraction of a percentage or a basis point difference in this. A basis point is 1/100%. That's still a few $billion saved to the taxpayers. So that's something that we're working on. And let me just conclude there. There's a lot of sort of, cool theory out there. I just want to give a taste of some of that. That starts with Vickrey 1961. Until 15 years ago, the field was extremely theoretical. But since then, especially due to the online applications of these things, it's just sort of exploded as a field of study. There's still sort of, questions out there as to whether bidders act according to theory or not. And this question of how should we design auctions to maximize revenue or efficiency is out there. And in many situations, it's an empirical question. And I believe, it's been about 50 years since we started doing this. Next 50 years is going to be even more interesting. And I'll take any questions, and thank you for, Please.
Can you address collusion in these markets, and when theoretically you expect to see it, or when empirically you've seen it, when markets are not thick?
I'm sorry. My wife is somehow calling me, sort of. Apologies.
I'm sorry. Just collusion in these auctions between bidders over the seller. When do you see that? When do you expect it theoretically? And have you seen evidence of that with Google or eBay? Thank you.
So collusion is a tough. So I would say it happens in situations where the buyers know each other and are in repeat relations. That's the usual intuition from economists. Whenever people are in a repeat relationship, that you can do sort of, well, I'll let you have this one, then you'll let me have the other one. You can have this, give or take type dynamic happening. Those are the situations that you can have collusion happening. I'll give you some really adverse examples. A student of mine wrote something on Italian procurement auctions, and he found basically something like 50%. So he was seeing in one region of Italy there were something like 15 bidders per auction. He said, "Great, isn't this competitive?" It turns out these were all related people. Right? The uncle, the nephew, sort of, they were all registered different companies and bidding on this. So there you expect something. And there was a beautiful paper on collusion in collectible stamp auctions. And there can be really intricate mechanisms through which bidders can actually run a pre-auction, figure out who's going to win the auction. The others don't show up to the auction so that they depress the price. The ringleader wins it at a lower price, and then they distribute the profits among the people according to a pre-selected scheme. It's a wonderful sort of case of some really sophisticated things going on into sharing these rents. So, I don't want to say this on the record so much, but I suspect, maybe not here, but in some other countries, a big chunk of auctions are rigged in this way. Yeah.
Going back to the issue of the electricity markets, that's still not the end user.
Correct.
So Reliant is bidding on
exactly.
clients. So what happens if the good is a commodity like electricity, but the bidder is the actual person, the consumer is not going to resell it? Does anything change, or you don't worry about those situations?
Things change in the sense. So there, the end user not so much bidding is a big problem, for example, especially in places like California, where there was almost a meltdown, because what happens is that they opened up the wholesale market to competition, where suppliers are bidding, but on the demand side, consumers were not seeing the price signals. The prices were set for a long time, and people just paying the same price, turning on their AC, because they were not seeing a spike in the price in the wholesale markets. It wasn't reflected in their bills. So that created very inelastic demand, and when demand is inelastic, it doesn't respond to prices, then you suddenly have situations where some firms have extremely pivotal market power opportunities. And this is what happened, Enron, and the likes back in 2000 really made a lot of money exploiting their market power that's caused by the inelasticity of demand. So there, I would say the development there is to make consumers more price responsive. That will also help lower the market power of these firms. In that sense, I think what you're saying.
Well, the difference between bidding for painting and bidding for electricity.
Yes.
But also, you're the end consumer and not the end reseller.
I see. Okay. Good. So you're saying in the resale situation, that they're sort of, if you're reselling, right, how much should you bid for it? Well, the price you think you're going to get in the resale market, that's going to bound what your value is. In that sense, it's going to change it. It might also introduce a situation of, where you don't really know what the value is, because the resale market is going to pin down what the value is, and that's going to introduce this winner's curse situation. That's where winner's curse might apply as well. That's what we think about in these resale auctions. Yeah. Yeah.
My question is a little bit more about how prices are set in this market. Thank you. Thinking about market efficiency, a price should reflect all the information available about that particular asset. Yeah. So in your experience or in your research, have you seen that auction markets tend to be efficient markets by that standard?
In terms of reflecting the prices afterwards?
Reflecting the information available about that asset.
I mean, that's a good question. I mean, it's a lot of times it depends on the market depth. I mean, so we have, theoretically very good results as to, if there's a large number of buyers, then, the prices in the auction is going to reflect the true value, at least in expectation. But, if the auction has only a few bidders, then there can be very large departures from, what the actual value is. So again, the number of bidders being a crucial aspect of the efficiency of the auction comes back there. If you have one bidder or two, if you have one bidder, you've got a big problem. Two bidders a lot of times is good enough, but you want to have as many bidders as possible to achieve this type of informational efficiency that you're talking about. I think that's the usual intuition there. Yeah.
What about things that are very irrational, like the emotion of somebody who's bidding on something? How do you break that into the equation?
We don't. I mean, sort of game theory is right. So I think sort of from the empirical point of view, you can say, this is people seem to be bidding way too high for this thing. But yeah, unfortunately, right now we don't have good theories of this emotional arousal, if you will, to account for these things. But we know in practice, right, auction houses, they try to create this, they send, shills or people to sort of bid phantom bids to get people to excited about an item to get the prices up. To that, we don't have too much of a sort of theoretical answer because, I think the theoretical answer is those bidders are not going to survive in that marketplace too long. These are more one-shot type bidders. Over the long run, they lose too much money and they exit the marketplace. Yeah.
You presented a theory there in 2007. I don't know the
Yeah.
person, but they proved that first price and second price auctions for the revenue is basically the same.
Yes. Yeah.
Do you think that's because in second price auctions, because the people in the long run, people are revealing what they're willing to pay, and so the minimum price goes up? Does that have to factor in? Because that's what we experienced with Google, is that the minimum price keeps going up because Google knows what you're willing to pay.
I see. Actually, that result applies to sort of even just the first run of that auction, if people are perfectly right. But I think what you're saying is maybe over time people are learning this game theory strategy, going to that, and then once they've reached that result will hold. I think that would be a nice illustration of that point. Sort of because Meyerson assumed that they're at that game theorist point at the beginning. Right. So if they've reached to that point, then yeah. Yes.
As a statistician, it's amazing to me that you deal with such disparate really populations. Undergraduate, the one-time, the kind of people who will go on eBay with valuable objects, another kind of person, the kind of people that go to Christie's or Sloan's or someplace like that are such different populations, and yet you seem to be convinced that the underlying mechanism in all of these different populations is somewhat the same, but you don't really have any random data in terms of population, selection bias, or the other kinds of things that would concern me, are of concern to me in generalizing what you're talking about.
That's a good point about different populations. I would say, I think following the point that I made earlier, people who have been in the market for a while are pretty good at what, that's sort of my, at least, there are a bunch of sort of findings. My colleague John List, for example, has done a lot of experiments with, experienced baseball card dealers, even baseball cards. He shows that, after people have done something like 30 or 40 trades, they're at the line where Homo economics would be. So in that sense, that gives me some sort of faith that, to the extent that I can select a sample of people who have some minimum amount of experience, they can be pretty comparable through context. But you are right. I mean, sort of extrapolating any of these results across markets, is difficult. So that's why I think I'm with you in the statistical sense that, a lot of these are more sort of context-specific situations. There was a program out there that I laid out, the Vickrey and Meyerson. There's one theory that's going to explain everything through the game theorist angle. But I think what the field is converging to is it's much more sort of context-specific than that. And that's where the field is evolving, if you will. But that's possible because now we have all sorts of data to test our theories and reject their theories. And once the theory is rejected, then you have to develop new theories and maybe add things like these behavioral, behavioral bidding patterns, etc., into this.
Now you're speaking to the paranoids among us. That's really the fear of everybody, and Google knowing more about you and then being able to use that to define the population that behaves in this way. It's going to be an interesting 50 years.
This will be our last question.
Oh, okay.
Excellent. No, Professor, thank you so much for coming down here. Really was a pleasure to have you, so thank you so much.
Thank you. Thank you. Thank you. Thanks a lot.